Hello everyone, this is a video about selected S&P 500 stocks and Tesla and how they have behaved, their financial performance, their stock performance over the past year, 2019 to 2020, over 250 trading days, which is a year in the stock market, and this is as of today, 10 September 2020. So I have included Tesla first of all in this list because I think it is definitely a stock that belongs in the S&P 500, and it is a matter of time before it finally gets included in the index. As you can see, the Tesla has been the best performing stock over this past year with a return of over 644% and a market capitalization of over 360 billion. Now, let me say in this point that the return has been calculated as the price at the end minus the price at the beginning over the price at the beginning. So in reality, the return might be lower. So we have Tesla number one. Then at number two, we have NVIDIA. Number two, we have a company called Dexcom. Number four, we have a company called AMD, Advanced Micro Devices, very well known. Number five, of course, Apple. Everybody knows Apple. Number six is Regeneron. Number seven is West Pharmaceuticals. Number eight is Align Technology. Number nine is ServiceNow. And number 10 is Amazon. The source of all this data has been Yahoo Finance. We see a very big difference among the returns with Tesla and 644%, while Amazon has 77%. Of course, the market capitalizations are very different among these firms. So the first question is, why do we care about the past performance? In the finance research literature, a very well-known paper by Zegedis and Titman is called Returns to Buying Winners and Selling Losers, Implications for Stock Market Efficiency, published in the Journal of Finance in 1993. This is one of the most highly cited papers in finance, with over 12,000 citations as of today. So Zegedis is a professor of finance at Emory University, and Titman is a professor of finance at the University of Texas. So what they find in this paper, and I quote here, is that this paper documents the strategies which buy stocks that have performed well in the past and sell stocks that have performed poorly in the past, generate significant positive returns over 3 to 12-month holding periods. However, part of the abnormal returns generated in the first year after portfolio formation dissipates in the following 2 years. So momentum is part of what is known as market anomalies, which go against what is called the efficient market hypothesis. So the previous returns, of course, are not a guarantee of future success. All investments are subject to risk and potential loss of capital. Investors perform their own research while investing in stocks. On the other hand, returns are rewards to risks that investors undertake. These are known as risk premia. The prices have included in them information, and stocks have risen in many cases due to fundamental reasons that are either related to their past, their present, or what is expected of them in the future. So let's see briefly what these stocks firms do. First of all, Tesla makes, of course, electric cars such as the Model S, X, 3, and Y, and has forthcoming vehicles such as the Semi and the Cybertruck. NVIDIA makes graphics processing chips. Dexcom is an interesting company since it controls devices that control for diabetes, such as continuous glucose monitoring systems. AMD, very well known, computer processors and graphics processing units, known as GPUs. Apple, of course, everybody knows Apple, cell phones, iPhones, computers, iMac, MacBook, tablets, iPad. Regeneron is a pharmaceutical company that deals with autoinflammatory diseases, some forms of cancer, cholesterol, rheumatoid arthritis medication. Number 7 is West Pharmaceuticals, which works along the top pharmaceutical and biotechnology companies by producing pharmaceutical packaging and delivery systems. Number 8 is Align Technology, which manufactures 3D digital scanners and clean aligners used in orthodontics. Number 9 is ServiceNow, which is a cloud computing company designed to assist companies with digital workflows. And of course, everybody knows Amazon, the giant of e-commerce. The goal of this video is not to give details about each of these companies. We would need a separate video for each of these companies, but I would like to go into more detail a little bit about Tesla. So Tesla has had a phenomenal run, spectacular run in the past year. Back in August 2019, the stock price was $42. Today it is about $400. So many people wonder whether this stock is a bubble. So few people can doubt that Tesla is one of the most innovative companies in the world, pushing the frontiers on multiple aspects of technology, research, and engineering. Tesla has proven to draw some of the top talent as far as employees are concerned. Many people say that the Tesla stock price has been parabolic and that this is not sustainable. $42 to $400 is almost 10 times higher. But this has happened before. It's not the first time it happens with Tesla. For example, Amazon. But the graph of the stock price looks very parabolic also. Back in 2010, the Amazon stock price was $133. Today it is over $3,300. This is 20 times higher than it was. More recently, 2016, the stock price was $500. Today it is more than 6 times higher than it was 4.5 years ago. So in October 2001, the stock price was $8. This means that the stock price today is more than 400 times higher than it was in 2001. So $10,000 invested in Amazon in 2001 would be worth more than $4 million. Apple stock price, another company with a parabolic stock rise. It was $7 in 2010. Today it is $117. This is over 16 times higher. In January 2000, it was $0.9. Today it is more than 130 times higher. So $10,000 in 2000 would have been worth over $1.3 million today. The data source for all my data is Yahoo Finance. But we have to be careful here because no stock price goes up on a straight line. As one can see from the Amazon stock price in 2018, in September 2018 it was $2,000, but then it fell to less than $1,400 in December 2018. So this is a drop of about 32%. So a $10,000 portfolio would have lost more than $3,000 in 3 months. In 3 months of a continuous fall is quite painful for the investor. And it wasn't until July 2019 that Amazon the stock price went above its 2018 September stock price. So this is 10 months where you have no capital appreciation. Once more for Apple, if one sees the stock price, the graph in 2018, in September 2018 the price was $56 and it fell to $37 in December 2018. So this is approximately 34% drop. So a $10,000 portfolio would have fallen to $6,600 in 3 months. Once more, until October 2019, the Apple stock price did not reach above its September 2018 price. So this is more than a year where you have no capital appreciation. So there has been criticism about the high PE ratio of Apple. This is 1,000 as of September 2010. But this has been the case with other companies. For example, Amazon had a price to earnings ratio of 3,000, over 3,000 in 2012, over 1,000 in 2013, over 800 in 2014, over 700 in 2015, and so on. The source for this is macrotrends.net. So Tesla has had a phenomenal run. It is the number one best performing stock in the S&P 500 plus Tesla dataset. So the past performance might be an indication of future success according to the momentum anomaly, but this is not always the case. This is just an indicator. and stocks that have performed well might underperform in the 2 to 3 following years, as was mentioned in the paper by Zegedis and Titman. So after this phenomenal success, no one can doubt that Tesla has pioneering research and innovation excellence, that Tesla attracts some of the best talent in the US and across the world. So a lot of attention has been drawn by the investment public, often comparing Tesla to top performing stocks like Apple and Amazon. We said that the price to earnings ratio can get quite high, and this has been the case with other stocks as well. It should not be the only indication of valuing a stock. But in any case, no stock goes up in a straight line. If you see any graph for any stock, you will see that it goes up and down, even the best performing stocks. So drops in the range of 20, even 30, or in some cases even 40% can be well anticipated. And this has happened even to the best companies out there, such as Amazon and Apple. So it's good to have an investment horizon of at least 6 to 12 months and do not panic over some short-term return, short-term losses, which might be 20, 30%. These things can happen. But in the long run, good stocks get rewarded with good returns. So good luck and see you in the next video.